Bed Bath & Beyond had a coupon. A single blue and white coupon. 20% off any one item. For 30 years, that coupon showed up in mailboxes across America like clockwork. People saved them in junk drawers, in glove compartments, in stacks on kitchen counters. Some customers had hundreds of them. That coupon was not a marketing gimmick. It was the entire relationship between Bed Bath & Beyond and its customers. And the day a new CEO decided to get rid of it, the company began its final countdown to bankruptcy. This is the story of a retail giant that survived Walmart, survived Amazon, and then destroyed itself with its own decisions in less than 3 years. To understand the fall, you need to understand what Bed Bath & Beyond actually was. Founded in 1971 by Warren Eisenberg and Leonard Feinstein in New Jersey, Bed Bath & Beyond started as a small linen store. The founders had a simple philosophy: carry everything, stack it floor to ceiling, and let the products sell themselves. No fancy displays, no elaborate store design, just an overwhelming selection of home goods at competitive prices. By the 1990s, the format was working. The stores were enormous, sometimes over 80,000 square feet, and they carried an almost incomprehensible range of products: bedding, cookware, towels, storage, small appliances, cleaning supplies, candles, picture frames. If it belonged in a home, Bed Bath & Beyond probably had it. At its peak in the mid-2000s, the company operated over 1,500 stores across the United States and Canada. Annual revenue reached $12 billion. The stock was trading above $80 per share. The company had bought back so much of its own stock that its market capitalization was actually lower than its total historical earnings. Bed Bath & Beyond was not just surviving the Amazon era, it appeared to be thriving. The coupon kept customers coming back. The selection kept them spending. And the locations, placed in strip malls and shopping centers across suburban America, were exactly where their core customers lived. Then, in 2019, everything changed. The company's longtime CEO resigned. The board, under pressure from activist investors, including hedge funds that had taken large positions in the stock, decided it was time for transformation. They hired Mark Tritton, a former Target executive who had been credited with revitalizing Target's private label brands. Tritton arrived with a mandate to modernize. What he did instead was systematically dismantle everything that had made the company work. The first major decision: eliminate the coupon. Not reduce it, not phase it out gradually. Eliminate it. The 20% off mailer that had defined the brand for 3 decades was discontinued as part of a broader strategy to move away from promotions and toward everyday low pricing. Customers noticed immediately, and they responded.
Elimination was
by
only the
shopping
beginning.
somewhere else.
Tritton's second major decision was to replace the store's national brand products: the KitchenAid mixers, the Cuisinart coffee makers, the Dyson vacuums that customers specifically came to buy, with private label brands that no one had ever heard of. The strategy made sense on paper. Private label products have higher margins. Target had done it successfully. If customers were loyal to the store rather than the brands, they would buy whatever the store recommended. But Bed Bath & Beyond customers were not loyal to the store. They were loyal to the coupon and the selection. The entire value proposition was, we carry everything and you can get 20% off. Remove the coupon and replace the national brands with unknown alternatives, and there is no value proposition left. Sales dropped immediately. Customer traffic collapsed. The stores began to feel empty, not because they were understocked, but because the products customers wanted were no longer there. While Tritton was dismantling the business, the board was executing a financial strategy that would make recovery almost impossible. Between 2019 and 2022, Bed Bath & Beyond spent approximately $1.3 billion buying back its own stock. This is the same mechanism that destroyed Toys R Us. Capital that could have funded transformation being used instead to return money to shareholders in the short term. While the company was spending over $1 billion on buybacks, it was simultaneously closing stores, cutting staff, and watching its core customer base walk away. The stores that remained open were understaffed and poorly merchandised. The website was mediocre. The inventory systems were outdated. By early 2022, the stock had fallen from a high of over $30. It had never recovered to its previous peak, to under $5. Then something bizarre happened. In January 2021, Bed Bath & Beyond had become a meme stock. Along with GameStop and AMC, retail investors on Reddit coordinated to drive up the price of heavily shorted stocks. Bed Bath & Beyond's price spiked from under $5 to over $30 in days. It happened again in August 2022. A 20-year-old investor named Jake Freeman disclosed a large position in Bed Bath & Beyond stock. The price spiked again, this time from under $5 to nearly $30 in 2 weeks. Freeman sold his position near the peak, reportedly making approximately $110 million. One of the most prominent voices promoting the stock during that run was Ryan Cohen, the founder of Chewy and a board member of GameStop, who had taken a large position in Bed Bath & Beyond and publicly suggested the company had significant upside. Cohen sold his entire position near the peak of the August spike. Within days of Cohen's sale, the stock collapsed back to under $5. Thousands of retail investors who had bought during the spike lost most of their investment. A 20-year-old CFO named Gustavo Arnal, who had joined the company months earlier, died by suicide shortly after the stock collapse. He had been named in a lawsuit alleging he and Cohen had artificially inflated the stock price before selling. The lawsuits, the scandal, the stock collapse, and the ongoing deterioration of the underlying business converged at the worst.
Bed Bath & Beyond was running out of options and running out of cash. The company attempted to raise money through stock offerings, selling new shares to generate capital. But each offering diluted existing shareholders and signaled desperation to the market. The stock continued to fall. Vendors began demanding payment up front. Suppliers who had shipped merchandise on credit for decades now wanted cash before delivery. Shelves in some stores began to look sparse, not by design, but because the company could not afford to restock them. The final months were brutal. The company announced store closures by the hundreds. Employees showed up to work not knowing if their location would be next. Suppliers were owed hundreds of millions of dollars. Lenders were negotiating the terms of a restructuring that never materialized. In April 2023, Bed Bath & Beyond filed for Chapter 11 bankruptcy. The filing listed approximately $5.2 billion in debts and $4.4 billion in assets. The company had employed approximately 14,000 people at the time of filing. Most of them lost their jobs within months. The stores were liquidated. The shelves were emptied by shoppers hunting for discounts in the final weeks. The blue and white coupons stopped coming in the mail.
The Bye Bye Baby stores, a subsidiary that had actually been performing reasonably well and which many investors had hoped would be spun off separately, were also liquidated as part of the bankruptcy. Billions in potential value, gone. The domain name, the intellectual property, and the brand were acquired by Overstock.com for approximately $21 million. Overstock rebranded itself as Bed Bath & Beyond online, a digital ghost of a physical empire. The actual stores are gone. All of them. So what actually killed Bed Bath & Beyond? The simple answer is bad management. Tritton's decisions, eliminating the coupon, replacing national brands, misallocating capital on buybacks, were catastrophically wrong for this specific business. But the deeper answer is more uncomfortable. The board that hired Tritton, the activist investors who pushed for transformation, and the financial engineers who approved the buyback program all contributed to an environment where short-term financial metrics were prioritized over the actual health of the business. Bed Bath & Beyond had real problems before Tritton arrived. The stores were dated. The digital presence was weak. The coupon strategy was expensive. These were legitimate challenges, but the solution was not to eliminate the one thing customers actually came for, replace proven products with unknown alternatives, and spend $1 billion on stock buybacks instead of fixing the business. The coupon had been a crutch, but it was also a relationship. And when you end a 30-year relationship with your customers without giving them a reason to stay, they leave. Every single one of them. Bed Bath & Beyond had 1,500 stores and $12 billion in revenue. It took exactly 3 years of bad decisions to turn that into nothing. The blue and white coupon is still sitting in someone's junk drawer somewhere, expired, unredeemable, and worth exactly as much as the company that printed it.